Most Indian migrants sell their property back home within the first couple of years of moving to Australia. That instinct is the most expensive mistake in the cross-border tax, and most people don't find out until they have already settled. Here is what happens. You sell a property in India, you pay TDS at 12.5% before cess and surcharge, withheld at source. You think the tax is done. You transfer the funds to Australia, and 3 months later, the ATO sends you a tax assessment, a 5-figure bill on the sale you already paid tax on. But here is what really stings. The exchange rate moved between the sale date and the transfer date, and that movement alone added tens of thousands to your taxable gain that you never saw coming. I'm a tax accountant and I have helped clients recover over $40,000 in over withheld TDS after Indian property sales. After working with hundreds of Indian Australian clients, navigating this exact situation, the same costly mistake come up every single time. Let's start with the part that catches almost all Indian migrants off guard. When you become an Australian tax and permanent resident, the ATO taxes you on your worldwide income, not just your Australian salary, everything. That includes the capital gain on the property sale in India, even if you have never bought a single rupee into the country. Let me walk you through what this actually looks like. Rajesh moved to Melbourne in 2021. He had bought an apartment in Pune years earlier for 40 lakh rupees. By the time he became an Australian tax resident, it was worth around 1.8 crore. He held it for a few more years and then sold it for 2.2 crore. In India, TDS was withheld on the sale, which was roughly 33 lakh rupees. Rajesh assumed that was end of it. So he transferred the funds to his Australian bank account and moved on. 6 months later, the ATO assessed him on the capital gain, not in rupees, but in Australian dollars, converted at the exchange rate on the date of each transaction. The exchange rate movement alone added over $18,000 to his taxable gain that he would have never factored in. And that was on top of TDS he has already paid. So here is the thing. Australia does give you credit for the Indian tax. It's called Foreign Income Tax Offset under Division 770. But that credit only covers the amount of Australian tax payable on that income. If your Australian tax bill on the gain is lower than the TDS you paid in India, you can't recover the difference through your Australian return. You have overpaid in India and that overpayment is gone. 2 countries, 1 sale, 2 tax bills. And if you don't coordinate both sides before you sell, the gap between what you expect to pay and what you actually owe can be 6 figures. So far, this looks like a nightmare. The ATO taxing Rajesh on the full difference between 40 lakh rupees and 2.2 crore rupees. That decades of growth that happened entirely while he was living in India. But there is a way around it. You just need to know this one mechanism most Indian migrants never use. It's called cost-based reset under section 855-45. The day you become an Australian tax resident, the ATO deem you to have acquired your overseas asset at their market value on that date. Not your original purchase price, but the market value on the date you arrived. Let me show you what it means for Rajesh. He bought at 40 lakh rupees. On the day he becomes an Australian resident, the property was worth 1.8 crore. He sold for 2.2 crore. Without the cost-based reset, his taxable capital gain is calculated on 1.8 crore of growth. With the reset, it's calculated on just 40 lakh rupees. The growth that happened after he became an Australian resident. In dollar terms, that's a difference between a tax bill of more than 60,000 Australian dollars and one closer to 15,000 Australian dollars. But here is the catch. The reset only works if you have a professional valuation of the property from the date you become an Australian tax resident, and it cannot be a rough estimate or an online figure. You must obtain a formal valuation from a registered valuer dated to your residency start date. If you don't have that valuation, the ATO can default to your original purchase price. And if your original purchase price was 40 lakh rupees 20 years ago, you are paying Australian CGT on 2 decades of Indian property growth. That had nothing to do with your time in Australia. The cost-based reset is the most powerful protection you have, but it only works if you have the valuation. No valuation, no reset. If you're finding this useful, subscribe. I break down cross-border tax strategies like this often, and most of what I cover is stuff you probably don't know. So let's talk about the money you have already paid, because most people think TDS settles their obligation in India. It does not. TDS is not your final tax bill. It's a withholding. India withholds 12.5% plus cess plus surcharge from the buyer at the time of sale. But your actual Indian tax liability depends on the cost base, your holding period, and which exemptions you qualify for under Indian law. In many cases, the TDS withheld is significantly more than what you actually owe. That excess is refundable, but only if you file a return in India and claim it back. Most migrants don't bother. They see the TDS come off, assume it's handled, and never filed. That's money left on the table in India before you even get to the Australian side. Now, layer in the exchange rate. The ATO doesn't let you pick a convenient rate. Under subdivision 960-C, every transaction converted to Australian dollars at the exchange rate on the date it occurred. If the rupee weakened against the dollars between your cost-based reset date and your sale date, your gain in dollar terms is larger than your gain in rupee terms. I have seen cases where the exchange rate alone added 20,000 Australian dollars to the client's taxable capital gain. Remember the FITO cap I mentioned earlier? This is where it really bites. If the cost-based reset has already reduced your Australian tax on the gain, your FITO credit shrinks with it. You have overpaid in India and your Australian return can't claw it back. Two traps: one sale, TDS sitting unclaimed in India, and exchange rate quietly inflating your Australian bill. Here is the biggest takeaway you can't afford to miss. There is actually one more layer to all this, and it is the ones that turns a manageable tax bill into a painful one. Every number I have shown you so far assume you have held the property long enough after becoming an Australian resident to qualify for the 50% CGT discount. But if you sell within 12 months of your residency start, which is exactly what most migrants do, that discount disappears entirely. Let me put numbers on it. Rajesh's taxable capital gain after the cost base reset was roughly 40 lakhs, about 72,000 Australian dollars at the applicable exchange rate. If he holds for more than 12 months after becoming an Australian resident, the 50% CGT discount halves that to 36,000 Australian dollars of assessable income. At a 39% marginal tax rate, including Medicare levy, that's roughly $14,000 in taxes. If he sells at month 11 instead of month 13, the full 72,000 is assessable. Same marginal rate, that's roughly $28,000 in taxes. The difference between selling 2 months too early and 2 months later is $14,000 in Australian taxes alone on one transaction. And the 12-month clock doesn't start from your original purchase date in India. It starts from the date of your cost-based reset, the day you become an Australian tax and permanent resident. That's the detail that catches people. You might have owned the property for 15 years, but as far as the ATO is concerned, you acquired it on the day you landed. The natural instinct after migrating is to sell quickly, consolidate your finances, and move on. That instinct is what the tax system punishes the hardest. Timing isn't a preference, it's a 5-figure decision. Okay, so now you have sold, you have paid the right tax in both countries. Now you need to get the money to Australia. Here is a process most people skip entirely. Under Indians' foreign exchange regulation, repatriation sales proceeds require significant documentation. Without it, the money sits in a holding pattern until the paperwork is sorted. On the Australian side, ATO expects you to keep records of the entire transaction chain: sale documents, TDS certificates, exchange rate evidence for every conversion, and your cost-based valuation. All of it in English or with certified translations. As per Australian tax law, you need to retain these records for 5 years from the date you lodged the return. The ATO is increasingly auditing foreign income and foreign asset disposals, particularly for recent migrants. Clean documentation isn't an option, it's your defense. Here is what a first conversation with our team looks like. We review your residency date, your cost-based valuation, and your TDS position. We map both jurisdictions side by side and tell you exactly what you owe, what you have overpaid, and whether selling now is costing you money it doesn't need to. The link is in the description. If you're holding Indian property right now, Book the call before you sign anything. One thing I didn't cover in this video is what happens when the move goes the other direction. I recently worked through a full tax picture for UK migrants moving to Australia, and the traps are just as expensive. Both countries think they have right to tax you, and neither one is automatically wrong. I made a full video breaking down exactly how that works, including one residency test most UK migrants fail without knowing it existed. That video is on screen now. Thanks for watching. See you in the next video.